Negative reward to risk ratios have always been an interesting topic for debate. There are people who say it is the best way, people who preach exactly the opposite. And in fact, if you follow most large institutional traders, they always say you should have your reward higher than your risk, such as a 2 to 1 or a 1.5 to 1. But mathematics says that's wrong. Mathematics, through proven statistical analysis, says that that is exactly opposite of what you should do. I've talked about this before, and I'm going to go through again and talk about it with another analysis. Real-world math. The Euro USD 1-minute candles, roughly 214,000 candles. This analysis goes back to 2020, the COVID bear market, and it's quite interesting. I did an analysis on GBP AUD as well, going back through the entire life of that asset, roughly all the way back to 2007 for the data I could get. Nearly 700,000 candles of analysis for that. Check the description for the link on that analysis. Also the source code I used, and both data files. Now we are looking at the screen where we can see exactly what we have, where I've ran all of the analysis for a myriad of take profits and stop losses. This is a single position trading technique using the support and resistance pullback strategy. The source code for that is also available and it can be found through the link below. Now we can see that I've done take profits and stop losses at 0.2%, 0.4%, 0.5%, 1%, and 1.5%. The basic approach I used is 0.2% is roughly 20 pips. So 1.5% would be roughly 150 pips. I felt this range was good enough for what most people would actually trade, and it certainly provided some very fascinating results. So as we look at this chart, and we can see some interesting details. The take profit and stop loss, these are percentages. The open, I'm using a single position size. So this means that there's one position open when I ended the analysis. So the maximum, of course, is the one position, and the number of sells. How many trades did I take place for that particular take profit stop loss combination? For the very first line, I took 2,174 trades. I won 1,086 of those trades, and I lost 1,088 of those trades. This is a reward to risk ratio of 1 to 1. That is, the take profit and the stop loss are equal. So we have a lot of interesting stuff here. So the first one is a loss. The second position is a loss. It's not until we get to the third position where the take profit is less than the stop loss. That is, it's a negative reward to risk ratio. I actually make my first real profit. So within the very first 3 lines of this table, we can see the unusual characteristics of the statistical probability of a negative reward to risk ratio being more profitable than a positive reward to risk ratio. And that's actually mathematically proven. If your reward to risk ratio is 1 to 1, that is, your take profit is equal to your stop loss, that means you have a 50% chance the market is going to go in either direction. So you have either way, the market could go against you or for you 50% of the time. That's a good, reasonable starting point. And for a lot of people, depending upon what you are actually using to get your entry point and how you manage your risk, that's more than enough. It works well for them. For a negative risk to reward, meaning you have a 1 to 4. So 1 risk to 4. You profit $1 for every 4 you potentially lose. That sounds backwards. That sounds messed up. That's not the way you want to trade. But the truth is, mathematically, you stand more of a statistical chance of moving that 1 position distance versus 4 positions against you. Let's put this in a real context. For the purposes of this demonstration, to keep the numbers easy to think about, let's use a 1% take profit and a 4% stop loss. It's easier for the market to move 1% in your favor than it is for the market to move 4% against you. Statistically speaking, you are 4 times more likely to have the market go for you than against you using this approach. So let's actually look at the table sorted by the P&L and actually see how that really works out in the numbers. Okay, we are looking at the table sorted by P&L. We can see the negative P&L all the way above the orange line on the screen. A take profit of 0.2%, a stop loss of 1.5%. That was a disaster. And there is actually a reason for that being a disaster that's not always intuitive. Sometimes your take profit is too close. And what happens is you can't make up the difference. And we actually can see that here. We won 569 trades, and we only lost 88. The reason this had the worst performance of all is because the amount of positioning trading, the relationship between your take profit and your stop loss, couldn't make up the difference. So there is a certain level of balance between your take profit and your stop loss. You don't want to be so skewed that you end up winning a vast majority of positions but still lose in the final P&L. So this is where you do have to balance within reason just how far or how skewed your negative reward to risk ratio is. That is critical. So as we continue to look at the negative values, we can clearly see that there is a relationship, even with a take profit of 1 to 2 reward to risk ratio. It still did not balance out. And this time we won 445 trades and we lost 565 trades. And we also had quite a losing P&L. So this isn't just a blind subjective. And the thing to really think about when you're looking at your take profit and what really shows up in this chart, when you look at this chart, 0.2 and 0.5, you can see that in these cases, when you look at your stop loss, you're not giving the market enough time to breathe. You're not allowing for room for volatility in this kind of a market. So this is more of the market just whipsawing versus take profit stop loss ratios. And that can often be difficult to see. So it's always a good idea to run a volatility variance on the market, because that can help you center where you actually want your market to be. Now let's go and look at the lower tables and see how well this works out. Let's see. The first actual profit is a take profit of 1 and a stop loss of 1.5. 196 trades and 117 wins. That's the first take profit we see on the chart that actually led to a positive profit level. Now, a 1 to 1.5 reward to risk ratio. That's not over the top skewed. But if we go lower, we see even more interesting results. Let's see, how about a 0.2 to 0.5 take profit to stop loss ratio? Again, we can see some interesting results here. It also was a profitable trading process. 1,398 trades, 984 of them were winning. Hopefully you can see the pattern beginning to form as we look at this information. It's not always easy to detect the winning combination, which is why these kind of analysis really take place. Okay, looking at the bottom of the chart, the most profitable is actually 0.5 to 0.5, a 1-to-1 reward to risk ratio. For Euro USD, this turned out to be the most possible, the most profitable, and it made a significant amount of profit, 675 pips of profit. That doesn't sound too intuitive either, but nonetheless, if we look at the previous combinations, we can see all of these combinations had some level of profitability, and all combinations, with very few exceptions, have a TP higher than a stop loss. Quite a few of them are 1-to-1 reward to risk ratios. And that's really one of the interesting points to take away. Now, it's more dramatic on the British pound AUD in terms of this relationship, because it's not as volatile and unstable as Euro USD. So this, as I said in the beginning of this video, this is not something written in stone, but overall, it's easy to see when you run this kind of analysis. When you actually look at the statistics and the probabilities. Volatility is your worst enemy, but once you know what your volatility is, then you can focus on trades that really make sense. Here's one that really seems counterproductive, and yet it actually did very well. So there's a lot of interesting points of view in this table that don't make a lot of sense. But when you look at the statistical probability of just what these represent, they do make sense in the world of mathematics. Share your thoughts. Let me know what you think. Have you ever tried this trading technique? Personally, it's one of my favorites. It's one of the best techniques I have ever used, and what I built my GridBot strategy on. Specifically looking at this kind of relationship between the market, volatility, and where I should take my take profits and stop losses. Let me know what you think. Leave me a comment. If you want the source code for this program or the data I used to get this information, please visit the link in the description below. Thank you for watching.